Getting some background noise from you too, by the way. I don't know if that's
I don't know.
you hearing that.
Nope.
That's weird. All right. Well, let's hope it doesn't transfer over. It's quite annoying. All right. We get started here. We get the socials. All right. Hello, Smart Money Cheap podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk. Happy Friday.
Happy Friday. It is a good. It's not Good Friday. It is a Good Friday. Yeah, it's been an interesting week this week. Had a lot going on. I don't even know where to begin. It's certainly earnings season has been going on. What, Dart?
Mixed.
Yeah. I want to talk about earnings a little bit because there's some stuff going on I think people should understand. But I'm scratching my head about New York, Doug. I mean, they elected a mayor that's a socialist or whatever you want to call him. He's clearly got different opinions than that city was founded on, capitalism. So I'm a bit curious where that's all going.
Yeah. I got an interesting comment from someone who actually lives in New York City now. A friend of mine that I grew up with. I'll kind of talk about what he had to say. So.
Yeah, I mean, we could talk about it more. I'm just kind of scratching my head. New York is like the center of capitalism and of the world in many ways, but it's fallen quite a bit since COVID. People are leaving. Companies have been leaving for a while. In my opinion, I think a lot of people that want to try stupid ideas should have their chance so that we can all learn what not to do, right? I don't want to be the test case. I don't live in New York, and I feel bad for the people that do. But hey, if you don't remember what price controls are all about and rent control and how bad that was, maybe you should relearn the lesson so we don't have to repeat it for the next 40 years. Because the last time it happened, didn't work. All this stuff that he talks about, I don't know how much of it is just to get elected versus how much is actually going to happen. I mean, practically speaking, if you want to destroy the city, he just gave you a roadmap. But, realistically, are the power brokers of that city going to allow that? Are the moneyed people in that city going to allow it? Don't know. Depends. I mean, he was supported by some big billionaires that seemingly want to destroy this country. So we'll see. We'll see what's going on there. But I'm scratching my head, but I am thankful I don't live there.
Yeah, well, and I won't go too deep, but that's exactly what I said. So I texted him. I said, "What are your feelings on the new mayor?" And he said that and this is a gentleman who is, for most of our lives, has leaned a little more left than I have. He was kind of one of those where I joked back with him. I said, kind of like the saying that Bill Maher and some of the others have said is like, I've always leaned left. I didn't move. They just moved more left than where I'm at right now. Right. And he said, I can't believe, I said, what are your first thoughts? He goes, I can't believe that another major city elected a self-proclaimed socialist to power, especially the city that invented capitalism. Again, the belief that both parties are shell of themselves. He said he finds himself agreeing with the Wall Street Journal. Now he's in the finance world most of the time because of the pro-business, sensible regulation view. But he did say, I still find New York City more sane than LA, where he lived prior to that. So,
well, the sanity part's interesting. I mean, there's actually what you just said was a really funny meme that Elon Musk puts out every once in a while, which is, you got the right here, you got left here, and Elon's sitting with the left. And then the other guy runs way far left, like across the other part of the screen. Elon doesn't move. And it's like, he's like, you're a right-wing extremist. He's like, well, I haven't moved. You just became extremist. And I just find that to be funny. But that's, in many ways, that's what's happened in the last 5 years. And it's swinging back the other direction. My dad always told me growing up that politics, just like culture, tends to swing. And it's a pendulum. It goes extreme one end, extreme the other end. Extreme one end, extreme the other end. And we just saw the extreme left with wokeism. I mean, it was just the worst thing ever. Mutilating kids, allowing men to beat up on women in women's sports. I mean, just terrible stuff that if you take it on its face value, you think like, what is wrong with people that they allow this? I mean, I won't get into that, but point being is it's so wrong on so many levels. And somehow we rationalized it because, well, we need to appease the 1% of the 1% of the 1% of the public that's really cuckoo. I saw this cartoon this week, and I thought it pretty much summarized. It was actually a marketing cartoon, believe it or not, and it was about marketing. So I'll describe it, and I'll try to put it in the show notes because I don't have it in front of me. But it was basically it was a cartoon. So there's a guy like a carnival barker, a guy who's a salesman at the front of the room, and he's like, "You should buy this thing." And everyone in the crowd's like, I love this thing. This thing is great. This is exactly what I needed, right? Then you got the next bar down, and you got one guy standing out, and he's like, I hate this thing. This thing is terrible. And so the carnival barker looks confused, and he's like, all right, well, let me go back and fix this thing. He's like, all right, this new thing, it has all this other cool stuff. And then the whole audience goes, well, I didn't want that thing. I don't want this new thing. This thing doesn't help me. And so everybody leaves. And he's just left with the one guy who yelled, I don't like this thing. He's like, what do you think? He's like, well, I never would have bought it anyway. And so the whole point of the cartoon is you don't try to appease everybody. You try to appease your audience. You speak to your audience. You deal with your audience. I mean, look at what Trump's done this time. He got elected on a platform to do certain things. He's doing those things. And you could argue whether he's doing a good job or not. That's not my point. But he's
other than release the Epstein files, which,
yeah, I mean, we won't go down that road. But the point being is like all the things he's saying he's going to do, he's checking them off. Maybe not all of them, but you know what I mean? Like he's been in office for like 9 months. So he's checking off all the boxes of the things that he said he's going to do. Great. A lot of presidents haven't done that. Some have, some try, and then they get smacked down by their, donors. But in general, like you're not trying to appease, like Trump has never tried to appease the left. I mean, politically, it's smart. You're just trying to appease your base. And he's not the first. Politicians have been doing this for ages. It's not new. You don't try to appease the other side because you're never going to. You're not going to get them because they don't care about you and you're not your audience. You want to find your audience. So anyway, we kind of got off track, but I just wanted to kind of point this out because you got a guy who got elected who's got a big enough audience, which is the scary part. It's not the fact that this guy has bad ideas. I mean, that's a problem, but that's not the issue. The issue is he got elected, which means there's enough people who thought his bad ideas were good ideas. Now, if you've been in markets, the economy for a while, you recognize this. This is bad thinking. Okay. It's kind of like if let's say I love clean energy. Let's say I think we need to green the planet and oil's bad and carbon's bad and all these things are bad. And I want there to be a clean planet. So I'm going to invest in clean energy, even though it doesn't make any money. I'm going to do that because I believe. You're trying to will the world to change to your perspective. That's what we call bad thinking, because you're never going to do that. The world is not going to change and bend to your will. What the world is going to do is whatever the world is going to do. You bend around it, it doesn't bend around you. So this, to kind of have this change over into investing topics, we want to transition this. This works doubly true for markets. So if you're investing in something, let's say you're investing in Acme Corp, right? And you think Acme is going to go up, but it starts to go down. You're like, no, but my fundamental analysis is correct. It's going to go up. And it keeps going down. Well, no, it's eventually going to turn around. And it keeps going down. You're like, well, I'm just too early. No, you're wrong. And what we as human beings find it difficult to do is to say that we are wrong. And when things don't go your way, you're wrong. And what you need to do is go back, reassess your assumptions, see what you missed, and then take another stab at it. So right now, for this year, the markets have been going like gangbusters. And as of October, the markets kind of moderated a little bit. It went sideways, and now they're starting to go down a little bit. And I'm not saying the market's going to crash, but I wouldn't be overly bullish right now. I would be looking at, all right, where are our opportunities and what are the good opportunities? And then, what's going to happen from here? We are going into the strongest part of the year. The back half of November and December and January tend to be some of the strongest months of the year. Now, we had a gangbusters September. Precious metals went through the roof. Hopefully you followed the show and you were listening to that because you probably made some good money. And now they're going to take a breather because they went too fast, too far, too fast. So the markets tend to do that. When the markets get out of line, and we're going to show you some charts here today, sometimes they either need to correct or take a breather. And a breather is bullish. A correction can be bullish as long as it's short. But the markets need to rebalance themselves. So what we're going to be talking about today is what that looks like, and some of these, basically what's going on in the economy, especially earnings season. We want to talk about that a little bit because we're starting to see some crazy stuff. And I really want people to kind of pull their head back and say, all right, maybe I should be cautious at this point because there's a lot of reasons to be. Whether the market continues to go up, I don't know, but I'm certainly being more cautious than I was before. And I think that's something to keep in mind. So any thoughts you want to drop, Doug, before I start getting into the weeds with some of the earnings and the market-based stuff?
Yeah, I'll keep it really quick, but I have a chart that it's a chart. It's a listing of year to date of different consumer cyclicals, and consumer cyclicals are one of those that is supposed to be doing better in a, generally speaking. I've looked at the track record of these over years, and they typically are not a great investment to be in, at least in the last decade in the markets, where a lot of the excitement has kind of flown towards and maybe more than decade, more like the last 15 to 20 years, where more money has flown towards technology and things that are more exciting, which we've talked about before. That's kind of what happens with the stock market. It's all what's exciting now. But they do have their moments, and those moments have typically been an area where they've held up better under the under more market-based duress, right? And you could argue that right now, maybe not in the markets, but in the economy, especially as we've talked about, the lower income levels have really started to pull back. There's more and more being reporting about people pulling back, even at higher income levels. Now it's starting to become more, the data is starting to show that's happening more often. But what is really interesting is and I think this is just a little bit of more of a sign of reason, I think, to look at caution, is because the area that's generally going to be more safe, in terms of where to have your money, and ultimately where a lot of value-based indexes and portfolios are constructed around, and also where you typically find a heavier holding in low volatility type investments, which people tend to move to in these types of take the profit, or more concerned outlook scenarios. We're actually seeing consumer cyclicals do absolutely atrocious. One of the examples leading it is Hain Celestial Group. Now this is one that has tended to buy into a lot of the organic movement, which again is food, and it's expensive food. They're down 80% year to date. But if we start getting into, and again, I could argue an understanding of that, just because, teas, which, Celestial Seasonings, that's where the name came from, and organic foods are areas that obviously people will pull back when they're trying to just fill their dinner plate. But when we start to look at areas like, Campbell's Company, General Mills, Kraft, Colgate-Palmolive, Clorox Company, Procter & Gamble, these are things that are generally going to be areas in which we're going to see a ton of money, or a ton of continual, consistent business. Now, granted, Why are these stocks underperforming? Partially because of the push of AI and other things. Where does money tends to leave and go other places? But they would normally start to be picking up right now in these economic conditions when people are maybe taking safety. We haven't seen a lot of people fly to safety right now. I think that's another thing why we're sending this caution. But we're looking at anywhere from 10 to 40% down year to date on those consumer cyclicals. Interestingly enough, Diageo Corp, which is liquor, which, just a sign of less drinking going on, but that usually goes up under stress, is down 33%. So I just kind of wanted to touch on that. I think that, the risk on is probably time to take a pause, but where the risk off tends to go, right now, they've got a lot of recovery to do to get back anywhere where they were at the beginning of the year. So.
Yeah, no, I couldn't agree more. I think we're in this period in time is we have, I'm trying to pull up the chart here because I want people to understand exactly what we're talking about here. So there's, here it is. Okay, well, there's two versions of this. So I'm going to share this one first. So we talk a lot about reversion to the mean kind of theory. And this is a 200-year, not quite, 150-year almost chart of the S&P Composite Index. And it's a regression to the trend, or we call it reversion to the mean. So what it's basically doing is putting a line right through the performance of the S&P 500. And what it's showing there are times where things are extreme from the trend, and there are times where it's less extreme. If you look at this, it was 106% from trend in 2000, and right now it's almost 200% to trend. It is so far extreme from where prices are that it really should give you pause as to, is this going to continue to go higher? Now this is a that was the best one. Okay, I was looking at another one, but it was basically the same thing. So if you look by almost any measure, things are really expensive, and I think we have a multitude of problems right now. There was a day, I think it was last week, where like most of the market was down, like almost all of them, but the 7 mega cap stocks were up. So the market as a whole was up. And we're seeing the stats like what, we showed when Doug was talking about the staples, food, liquor, Procter & Gamble, things like that were down for the year. And yet we have I don't know what the index is up, 16, 17% for the year, which is crazy. But a large part of it is big tech. So, we have a few problems. So tech has dominated the performance of the S&P for quite some time, by the way. I mean, if you look back over a decade, it's been this way. So it's not a new thing. But what is new is that big tech has changed their tact a little bit. And they've gone from a very highly scalable, capital efficient system to a capital intensive system, which is we need more data centers, we need more energy, and we need more compute for AI. Now, if you look at this, for example, here's basically CapEx in the AI era. So here's each one for last year and for this year. As you can see, Amazon looks like it's up about 35% higher. Google looks like it's about 70% higher. Meta looks like it's over 100% higher. Microsoft, I don't know, maybe 40. And then you got Apple. So you got all these basically AI CapEx, which is through the roof. Apple's not spending on AI. I find that interesting. Now, I think it's because Apple doesn't know how to innovate anymore. And I've talked about this in the show. They might keep cranking out dollar bills because they've got a captive audience, but they haven't innovated in a long time. And so that in itself is a problem. Every time they've tried, they've screwed it up. And right now they're not even playing in the AI game. They're not even playing. So now that may end up being the wisest move. because all these billions that are being spent by these other big tech companies into AI, I have a sneaking suspicion that this is all going to kind of go up in smoke. Now, I'm not saying AI is not a real thing. I'm not saying that AI is not going to improve or be the future. I'm just saying it's not going to be today. And so what tends to happen with tech is you get this huge run up, right? Everyone's excited about this new tech. It's the new thing. I got to invest in it. Goes to the moon. And then eventually people realize, we just spent $500 billion on this thing and we're making $5 billion a year. Something's wrong with this picture. Maybe this isn't sustainable. And so then it corrects, rightfully so. And then it bottoms out and people are like, I'm never investing this ever again. And by the time everybody says that, that's when it starts to take off again. So we haven't gone through that yet with AI. We're still at the bubble stage. And I would imagine that bubble may be popping. I'm starting to hear rumors that things are starting to maybe turn a little bit in the AI sector. So we'll see what happens there. But I do expect that we'll see, it will probably continue to see CapEx spending. But a lot of corporations are just not seeing the return. They're just saying, what am I doing spending money in this? I'm not getting anything out of it. I would say from my experience, AI 4 months ago was better than the same AI right now. And I haven't changed a thing, but the AI has changed. So, I think what we're going to start to see is we're going to start to see some diversions from reality, perceived reality versus reality. I mean, you see all these news stories. Here's another example. ChatGPT is going to destroy jobs, right? And I actually wanted to talk about propaganda right now. And this is something, if you haven't seen it, you'll start to see it. So there's been this thing for a long time that we need universal basic income because people are going to lose their jobs to tech. This has been going on for a while. It's not new. And as AIs come out, those chants have gotten louder. We need universal basic income. People are going to lose their jobs. And everyone's talking about AI is going to lose you're going to lose your jobs to AI. And they might be correct. It's not going to happen today. My earliest opinion, we're looking at 2 years before things get bad. Latter half, probably 10 years. So when you look at this, you might think, well, obviously, because look, it aligns perfectly with the release of ChatGPT. Look at this. The S&P 500 has gone up. Total job openings have gone down. It's tens of thousands of jobs, white collar jobs are disappearing. Like, this is basically what they're trying to portray in this chart. Now, here's the reality of it. Is that AI gives corporations a cover story for laying people off. They are not firing, and I can tell you this for a fact, corporations are not laying off people so they can hire AI to fill their job. That is not happening. Is it happening in 1 or 2 cases? Maybe. Is it happening in tens of thousands? Absolutely not. That is not happening today. Now, what you're hearing from earnings releases is, well, we instituted AI and look, we've been able to cut a lot of jobs. No, you're cutting a lot of jobs and you're using AI as the cover story. That's not the reason. Because if you go to any of these companies and you talk to any employees, you'll say, no, we're not using AI. It has nothing to do with that. It has to do with the fact they're trying to find a reason to cut jobs. It's not because our earnings stink. It's not because our revenues are going down. It's because of AI. Of course it is, and sarcasm for those of you audio viewers. Look, we are starting to see the markets turn over. We've been talking about this in the show for a while, that we're due for recession. And I know it's a broken record. And so we stopped really hammering the point home because the numbers just kept getting worse and worse. But now we're actually starting to see results from that. We're starting to see earnings calls that are not as rosy as people think. But even if you take all of the stuff, all the macro data, the economics, and you don't look at any of it, here's one thing you can look at. when a company comes out and beats earnings and the stock goes down dramatically, it means we're at the top of the market. It doesn't necessarily mean the very top, but it means at least at the bare minimum, a short-term top, which means that we could see a down cycle here for a short period of time. Could end up being a long period of time. We don't know, but it is the sign of a top in that stock, for example. So if let's just say I'm investing in Microsoft and Microsoft beats earnings by 50% and then the stock goes down. What? That doesn't make any sense. Well, what happens is the news is already baked into the stock and it underperformed what people thought. People really thought it was going to be 70% higher. So that is usually marking a top in that asset. Same thing at the bottom is if a company sends out terrible news, oh, it's awful, everyone's going to die from our product, and the stock goes up, that means all the bad news is baked in by the stock because the timing is perfect because everyone's getting rid of it. And if you're buying, you're going to buy at the bottom. Those are good markers. If you know nothing about economics, if you know nothing about earnings, if you're just a simpleton when it comes to investing, that is a simple thing you can apply and do reasonably well in the short term. Now, that's a good framework for a stock. What if you're seeing it with 100 stocks? Well, that's usually a sign that the economy's turning and the market's turning, and we're seeing that. We're starting to see that through the data. We're starting to see that through the metrics, and frankly, you know, some of the stuff we've been seeing for a while is just getting worse. But I just wanted to convey that point because the market is softening right here. I don't know if this will turn into a rout or not, but we are in one of the strongest parts of the year. Starting in 2 weeks, it'll be probably the strongest 2-3 months of the year. So you gotta be cautious here in the sense that the market is way overpriced, but also we're in a strong period. So we'll have to see how it plays out. I wouldn't be taking any outsized risks right here. I'd be very cautious. But you have to look for opportunities because there will be some opportunities. But when you see some great stocks being sold off for no apparent reason, or they're really cheap, but you're like, yeah, but the market keeps going up. How are they cheap? Well, we got a bunch of them. We got a whole list of them right now. And the only reason we're not buying them is because the market itself is set to drop. And if that happens, all stocks will go down as well, not just, you know, the big tech. It'll be all of them. So that's something to keep in mind, is that even if your stock is cheap and it's a good buy, you still want to be cautious because if the market goes down, it could bring down everything else. So what do you want to touch on, Doug? I had
a couple more thoughts on what you said. And I was trying to find the data, but there was a new report. You were talking about the data amount that AI is having to go under. It was, and I wish I could find it. It was something like 50% of the expense, or 50% increase, or 50% of the expense of OpenAI is now going to go towards data centers. They did just sign a $30 billion deal with Oracle, ironically, and there's a number of things that they're promising. They're actually asking government to get involved in helping to fund some of these activities. Elon Musk actually came out on one of the things that they recently said OpenAI was going to do, and he flat out said can't afford it. And of course, he's one of the early investors in OpenAI, so he certainly has some insight there that others don't see. They are definitely having astronomical growth in costs to support the amount of data that they're taking on. The other thing too, and I think you were talking about, you know, we have certainly we have certainly beat the the horse about risk, and as everybody has, risk management is just something that has been really you've had to be patient with over the past couple of years, over the past decade, as this market has just gone on into probably the longest winning streak, secular winning streak in arguably history, maybe certainly rival with the 90s. But I think when you talk about good news coming out, and the market reacting softly to that, we are seeing though that we have had an increase in layoffs. We've had, actually, I saw a report that just came out the other day that the number of layoffs this year is the highest number of layoffs we've had, tracking wherever they were tracking, but certainly as much, if not more, than what was happening in 2020. So when you start to see when you start to see unemployment figures go up, do go up. And granted, unemployment had been very strong, so of course you're just taking a lot of froth off the top there. But you're starting to see more of a whittling of these kind of middle income jobs, management jobs, white collar jobs, things like that. That is a that's going to put more out long term pressure on all of these different companies and their bottom line. So the profits have continued to be strong, but we are starting to see that, when you start to mess with the consumer and again, the government, the government shutdown, we've talked about this a little bit, how much impact it can or will actually have. But remember, one of the things that has been built up in the United States over the last, several decades is we have significantly increased the number of employment that, especially over the last 10 years, that went into government positions. We talked about that when we look at these government late job reports that would come out over the last 2 to 3 years, and you would talk, and then they go back and revise them, and they go back and take a microscope to them. Is like, well, yeah, okay, we added 186,000 jobs, but 150,000 of them were government jobs, right? So again, and what is the impact of that economically? In terms of employment when the government's doing the hiring. Well, now that we've had this job freeze, those individuals, if we have a higher percentage of employees in the United States, we've had a strong number of employees that have been laid off in the private sector. And then in the public sector, we're now sitting in a situation where employees are being furloughed or not being paid. I know several of them right now. And of course, they're going to get their pay. They're working for free at this point. But when the agreement comes through, the expectations are going to get paid. But until that actually occurs and that agreement occurs, they're not getting paid. So that is causing them to pull back in terms of how they're running their household right now as well. And those things, can and predictably do, the longer this goes on, have an impact to to our GDP and an impact to the buying power of the American employee, especially when there's such a high number in government. So those are definitely a couple of things that are going to put pressure that we're going to see, and start to realize, maybe not in this earnings cycle because it's so new, but definitely something to watch over the next couple months to see if there's any impact, what the impact of this is going to be. The other thing that you're talking about is like, hey, we've identified all, well, the market just keeps going up. How much of this, what do you mean that, there's companies not doing well in there? Well, I actually put a chart in there, Kirk, that shows basically the performance of the Mag 7, right, versus the S&P 493. And the S&P 493 cumulative return going back to 2015 has roughly gone from, basically to about 2 to 3%, where of course the cumulative return on the Mag 7 alone is somewhere around 14, or at least 14-fold. I don't know. They didn't mark it as percentage. It seems a little low to me on cumulative return, but ultimately it doesn't matter what the actual numbers are. The point is that we're talking about 7x the performance in just the Mag 7 of the rest of the 493 stocks combined. So a reminder to everybody that if you're holding the S&P 500 as an average, right, and you're saying I'm holding the 500 stocks, look at me, you're not. It is a very now, is that a problem? Is it a high risk? Maybe, maybe not. But the S&P 500, it will weight the return according to the highest market cap companies in there. So when you talked about the big seven, the magnificent, the big seven, and what they're doing, ultimately their performance, as long as it's strong, will keep driving the S&P 500. Now, if their performance exceptionally inverts, then you could see a significant and sharp decline in the S&P 500 from that. If it happens as a slow shift in the S&P 500, you won't feel it because in theory, though, as they're shifting, other companies will overperform in the S&P 500 and make up for that. But keep in mind, as a reminder, when you're holding the S&P 500, you're really holding the performance of those 7 companies.
Yeah, I think it's a really important thing to understand. I mean, we talk about it in the show. We talk about the concentration risk. And, we also talked about how even though there's concentration risk, every country in the world has concentration risk. The fact that ours is more diverse is actually an outlier, oddly enough. But it also means it's not good, right? It's like having an economy built on one stock is not sustainable, right? Long term, it's bad in many ways, but if you think about the performance of what's kind of happened, and it's all centered around 7 stocks, you might say, well, it doesn't matter because it's 7 stocks. Yeah, but what about the rest? So if we have, in my opinion, we've had like 100% inflation since COVID, and they're saying, well, it's only 30%. Well, yeah, it looks like the S&P hasn't gone up very much. Maybe that's in line with their proposed inflation, but not everyday inflation. So what the takeaway should be right now is, how do you invest in this environment? Now, in the 70s, that was a rough period. There was not a lot of growth in the 70s. Markets went sideways. They went up and down, but basically sideways over that period. And then when they went down, that was actually some of the cheapest stocks as far as I can remember. You had a PE of like 8. You had crazy cheap ratios. And that's when Warren Buffett, oddly enough, started to invest, and he was a rock star just by his timing alone. Not to take anything away from him, but like his timing was impeccable. So you couldn't do that now. It's not to say it's not possible, but it's very improbable. So right now you have to really be on your toes because the markets are way overinflated. And then the question is, well, yeah, but shouldn't they crash? No, I actually don't think they're going to crash, oddly enough. I think that if we might see a correction, having a 10 to 20% correction in any given year is normal. In every single year, there's at least one correction of right around 10 to 20%. It's usually hits like 10 or 20. It usually like hits the marker and then bounces back. That's normal. I mean, this year we had a 20%er in April with the tariff tantrum. If it goes down 10%, I wouldn't be surprised. It wouldn't even feel it. Most people will because they're expecting everything to go up forever. But the reality is that doesn't really happen. I do want to share some insights that I saw in the last week that I thought were very, very interesting. All right. So here's one of them. And obviously,
Kirk, can I add one more thing before you jump into that?
Yeah,
because
go ahead.
I think the other thing is, again, all that risk in 1 or 2 stocks. There's another chart I put in there that I think is really important to note. And I just changed my screen so you'll be able to see it better than I can because I can't get on it right now. But basically the margin debt. Okay. So not only is the stock market extremely stretched based on just a couple of stocks, but this goes back to, I think, 1999. I don't know if you can share it. I can look at it.
I'm sure.
There it is. Thank you. But you can see here that this is not one of these short-term charts. This is going back to 1998. And you can see that right now, margin debt just hit 1.1 trillion in history. That is a complete risk on, just an absolute belief that the market is going to roll. So you're willing to borrow against your brokerage accounts, and you're willing to take that money to buy and double down on more stocks. And you can see a number of patterns here that, May of 2000, when it hit that peak, what happened to the market after that, July of 2007, a slow decline until it took off the following year. Then 2018, 2021, and then September 2025. So this was posted on November 2nd, but 2020, the margin debt, they showed the September 2025 value, but according to this, it sounds like the 1.1 trillion. I don't know if that hit in September or now, but keep in mind that, basically we have a market that is not only propped up by speculation of just this excitement over AI and tech, but it's also propped up with a lot of doubling up your money through leverage. And that ultimately is something that creates a tremendous amount of risk, not only because people will pull back that risk when they start to get uncomfortable, but also if we have any type of pullback, you can lead to situations that, can basically be a rolling boulder of a rolling boulder of margin calls. And the last thing I wanted to say goes back to the AI. An MIT study, this was in the New Yorker the other day, found that 95% of companies that had invested in AI tools were seeing zero return, jibing with the emerging idea that generative AI in its current incarnation simply isn't all that it's been cracked up to be. Now, there was some response to that where people said, people were commenting saying, look, you need to read the report in depth, more detail. Most projects didn't fail because of AI, that they failed because companies don't know how to implement it. They prefer in-house instead of going with a vendor. Plus, they don't have clear objective and KPI and what they want to achieve. I don't think I disagree with that. I think that goes with what you said, Kirk. It's not necessarily that AI is a problem. It's not going away. It's just, have we gotten overexcited about the capabilities and the knowledge of how to utilize it now? And I think that learning curve is going to be a lot bigger than people thought.
All right, so we're going to go over some charts about the market to kind of give you some perspective of what we're seeing this week. So the first one is daily breadth versus daily change, and I'm going to try to explain this to you all because it can be a little bit hard. Breadth is effectively the number of stocks in the market, right? So if you've got 100 stocks, you would rather have 100 stocks going up than or having 100 stocks going down and having returns similar. But if you have one stock going up and 499 going down in the S&P 500, that's weak breadth and the market's higher, right? We just saw some of the worst for an up day ever. And that's when it looks like here about 200 stocks were up and 300 were down. And we had a positive day in the market. I think it's the worst, since 1990 is what it says. But
and it would have been a better day in the market if Facebook didn't blow up over what seems to be a ridiculous reason to dump it, because they had a one-time tax write-off.
Right. So when you're looking at stuff like that, you want to make sure you don't get caught too much up into that, because there is some perspective there that it really doesn't matter. But you should be aware of it. If you want to see a strong market, it means every stock's going up together. That's a strong market. If you only have a handful of stocks going up, it's a weak market. And so you just want to be careful of weak markets. It doesn't mean that because of that, we're going to have a crash. I hear this all the time. Well, most stocks are going down, so there's going to be a crash. No, it doesn't mean that. What it means that it's a weak market. It is a fragile market, which means that they could go up or down really quickly because there's not a lot of strength in unity. Because of the fact we have 7 stocks that are bigger than the rest, they're dictating performance. But if you have 500 stocks or 400 stocks going up, well, that's a strong market. So that you just want to be aware of that dynamic, because that can dictate whether you should be in the market or not. Like right now, it's weak, so I don't really want to be long in the market right now. Here's another one. I just want to share some of these as perspective. Don't get caught too much in this, but this is a typical November. These are kind of the returns for November, December, kind of the end of the year. So it's really kind of like 10 days into November plus December. So this is like year-end returns. This is if you take a bunch of years and put them all together and aggregate, this is generally what you're going to see. You're going to see the last week in November, those 10 days up higher. Then you're going to see kind of a slight upward trend. And then the last week, it goes higher. So this is kind of an aggregation. Don't spend too much time in this other than directional. Directionally, that's how the market looks overall, but it doesn't mean it's going to happen this year. It just means in aggregate, that's kind of what it looks like. Okay, that's the same thing. All right. I also want to share this. Okay, so here is the S&P 500 for September and October, right? And early into this week. And basically what you're seeing, and this is a technical chart, so if you're into technicals, you'll appreciate this. This is the range. So pretty much from September and October, it's been within a range. Then up and down, operating within a range. Then it went up at the end of October, and then it's kind of come back down. And this is what we call a flag. Now, the flag could be, typically a flag's bullish. It means it flags down. So it bounced up and then it kind of flags down a little bit and then it bounces higher. That is a bullish thing, right? The flags are bullish when they do that. Until they do, they're operating within this range, and that range could last however long it lasts. This is bullish. Now, it also could be that it's bounced higher and then it's retesting this area right here, this 6775 area where it broke out. It could retest that. Now, if it retests it and goes higher, that's also bullish. However, if it breaks below that area, the 6,700 area, somewhere there, I'm sorry, 6,775. If it breaks below there, that's actually really bearish. And not only that, but it tends to go faster in the other direction because it's just how technicals work. If you have support and resistance, if it breaks below support, if it breaks below support and then bounces higher, that's really bullish, and it goes higher in the other direction. So you just want to be aware of these things when you're investing and looking for entries and exits, because it's not just about what the right number is. It's also, is the market seeing it the same way you are? Now, I wanted to share this one before I send it back to Doug. I've been following this for the last month or so, and the chatter has gotten more and more intense. Now, there's a lot of conversations going on right now in the private credit space. In the last few years, people have been trying to promote private credit to the retail public, which is usually a bad sign. It was typically a institutional level or high net worth level kind of investment, and now it's getting promoted to the retail public, which generally means that it's towards the end. In this case, what it means is they can't find any additional institutional investor money, and they're running out of money, and they've got these opportunities. They want to put them to work. So let's sell it to the rubes. Let's sell it to the retail public. And that's a bad sign, right? And this is what's happened in real estate, in private credit, and private equity. It's happening. And you have this shadow banking world over there that we don't really see because nobody monitors it, but it's not looking good. So this is office CMBS delinquency rate, which is up 11.5%, 11.7%. We know this isn't good. Like, this is not a secret. We know this is high. We know the delinquency is high. I'm not surprised at this. But you want to watch this for when it actually starts to turn the other way. Because right now, high office delinquency rate, when you have higher interest rates and you have rollovers and it's not working, that's something we knew about. At some point that turns around and there's tremendous opportunities. I would not want to be buying here, but I'd be really observant about what's going on, because at some point it does make sense to buy office, but I just wouldn't do it right now. I'm also starting to see, although I don't have a chart for this, I'm also starting to see people getting a little antsy in the credit markets, and we're not seeing it in a major way yet, but I'm starting to see enough of it where I'm watching it closely. I would just be really cautious right now in fixed income. It's certainly going directionally in the right direction. Interest rates are going down, and that's a good thing for investors. But I would just be really mindful of where it's going, because they're trying to lower interest rates. At some point, it's not going to be feasible to lower anymore, because at some point that leads to higher rates on mortgages or what have you. Like, there is a bottom. We don't know where it is. We're going to find out really quick. It could be 1% lower. That's what I've been hearing. So mortgage rates are around 6. I could see them dropping to 5, and then that's as low as they go. That's kind of what I've been hearing. But because of the fact we do have inflation, and at the same time they're lowering interest rates, it's just bad news. So anyway, I just wanted to leave everybody with this. And here's an example of trueflation, that inflation's picking up. It's in context of a year, so picking up, that's a relative term. But anyway, since April, we're starting to see inflation pick up a little bit. Not a lot, but a little bit. So it's just something to keep an eye on. Not lose your mind. Don't run around with your hair on fire. Just keep note of it. And you want to just be watching these things and just see where things end up. We've been through a lot of the big earnings numbers, and I expect we're going to see more numbers next week, and that will be telling about where we see the market going after this. But I think earnings season has not been as rosy. The results haven't been as rosy as I think people thought, and I think it's a good indication that we should be cautious. All right, Doug, you can kind of wrap it up with any thoughts you got.
Yeah, actually, I got a kind of a fun. It come to a couple fun little memes here, things here. If you were to take a look at some of the last things I posted, I thought there was just going back to 1998, Paul Krugman, Nobel Prize winning economist. He said by 2005 or so, it'll become clear that the internet's impact on the economy has been no greater than that of the fax machine. I thought that was funny.
He won a Nobel Prize, Doug. He's really smart.
He's very, very, very smart. I think we've come a little bit further than that. But what I do think is really funny is we've loved to talk about AI, and there has been some absolute. I think OpenAI just made and came out and publicly made a significant change to the advice that they are no longer going to allow ChatGPT to give. It's no longer going to be allowed to give real-time market advice or real-time trading advice. I actually saw a study recently where
did they say that? I know they said medical advice and legal advice. Did they say investment advice?
I think I believe I saw something that said, yes, investment advice as well. And I did see a chart that showed some of the advice that they had given was, well, let's just say, go invest in the Pelosi tracker. Anyway, so yes, I love this.
You're retiring. You won't be able to use her anymore.
Listen, her greatest influence on the history of America will never pale compared to her influence on the stock market. We'll leave it at that. Is this mushroom edible? Yes. Whoa, you're right. It's a poisonous mushroom. Would you like to learn anything more about poisonous mushrooms? It just says AI to a T. Is this mushroom edible? And for those of you that can't see, it's showing a very toxic mushroom that they're holding and asking, is this mushroom edible? And of course, AI is responding, yes, it is. And then it shows the person in a hospital bed. It has obviously updated them. I don't think that's correct. And it's funny because I actually was putting something together for someone today, and I was using AI to help kind of craft it. And it had said that it was a single individual. And we were talking about, being able to fund a Roth IRA for their child and earned income. And it's funny because the AI came back and said, you can, if you have earned income up to $14,600 for 2025, standard deduction, you won't have to report it. Well, that isn't accurate. I went back to the AI and said, I'm pretty sure that the standard deduction this year is actually $1,500 and change, or $15,000 and change. And it's like, oh yeah, you're right. That 1,400 was outdated. That was 2024. So I just want to prepare everybody that yes, AI is absolutely getting better, but we call holograms, which is basically the fraudulent the responses that it gives you, still has a long way to go to clear those out of the system. I'm going to leave it with this. As you can see, the markets are really loud right now, but the signals don't match the story. Okay, we have record margin debt. We have the narrowest S&P breadth arguably in history. We've got commercial delinquencies climbing past financial crisis highs, and we have job compression from AI eating middle tier of white collar America. On paper, it does look like there's prosperity, but underneath is a fact that there is some fragility. And the problem isn't just market risk. Ultimately, it is blindness. There's a lot of investors out there that have no true map of their financial life, flying without instruments. I just talked to a family worth about $4 million that has no idea where all of it is. Okay. Smart money families think differently. And the reason they're talking to us is they want to pull that together. He's concerned that his wife doesn't know where things are going to be if something happens. She was concerned about it. She's also concerned that, look, I see him working every day. We have this money. We put it away, but we're stressed, right? So, and I see that stress on him. Why are they working? They don't know why. I mean, obviously they know they work, they know they earn, but they don't have the picture. Smart money families see everything. They see the income sources, the liabilities, the tax exposures, tuition timelines, the sequencing of events and assets that must work together, not against each other. And they make sure that every dollar has a job, every risk has a boundary, every goal has a funding source. That's the difference between having investments and having a plan. I talked to another family the other day, and to quote this individual, I'm a couch potato when it comes to my money. But he's already given a couple $1 million away to his family. He's got assets. He just doesn't understand how they're all working. And those questions start to boil and bubble up. Remember, if you're feeling it in your gut, it's probably true. Real wealth isn't the pile, it's the paycheck. So if your retirement income plan or college funding strategy or your wealth still lives in that set it, forget it world of passive hope, you are one correction away from discovering what fragility feels like. When the credit cycle cracks, which it has before, or tuition spikes again, those without a clear financial map can find out too late which side of the line they're on. The families that thrive, they build in sufficient margins of error. They understand where everything is. They insulate income from market chaos. They treat college and their other assets like multi-year cash flow events, not surprise withdrawals. And then they use today's clarity to prepare for tomorrow's uncertainty. So I want to leave you with this. Ask yourself, are you planning for today's risks, or are you assuming yesterday's rules still apply? If you really want a plan that actually functions under pressure, one that connects wealth, income, and your family's future, let's have a conversation. Go visit us at our new website, mergentadvisors.net, MERGENT, mergentadvisors.net. I'll spell it again, MERGENT. You can also go to mergentadvisors.com. That has now been integrated into our Mergent Advisors website. Don't just collect statements, build your map. Clarity isn't optional anymore. It is the new definition of wealth.
Awesome. Well, thanks for coming on, Doug. I got one final thought, and then we're going to wrap it up. I was reading some of I forgot to mention this, but I was reading some of the earnings reports, and here's kind of a quick summary of some things that I'd written. If you look at it, especially the restaurants, all the businesses are suffering from the same fundamental problem: persistent cost inflation, combined with an inability to push through inflation without causing a loss in customer traffic. Insurance, utilities, and food costs are all rising well above the CPI. Notably, beef prices are up 30% year over year. If you look at a lot of these companies, you're hearing the same things. Kraft Heinz said we're now in one of the worst consumer sentiments we've seen in decades. Etsy, buyers are more selective, price sensitive amid ongoing economic uncertainty, leading to moderated growth in gross merchandise volume. Let's see, Gap, we're navigating challenging consumer landscape where middle income shoppers are trading down or deferring discretionary purchases due to economic pressures. ConAgra, consumer sentiment remains weak. We still see value-seeking behavior. We expect inflationary pressures and weak consumer sentiment to persist. eBay, shares dropped a lot. The operating environment is expected to be challenging due to persistent economic headwinds. And then Caesars Entertainment, I think
Vegas is a disaster right now.
20% decline year-over-year revenue from their Vegas properties. All this to say that we're seeing all this against broad swaths of the industry. It's starting to actually impact people. The class, most people, I mean, the poor can't change much. The middle class are trading down, so they're buying cheaper stuff. All this is going to start to filter down and going to keep impacting earnings. So, if I was a betting man, which I'm not, I would say that the next year is going to be rough. And so, we'll keep talking about this. We'll keep everybody up to date as to what we hear, and stay sharp out there. Now is not a time to be a pig. Now is a time to be cautious and manage risk properly. If you don't know how to do that, you can give us a call. We can talk about how we do that. We've actually been handling it quite well this year. And if things get really rough, we're going to be in good shape for that. So that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kurt Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please leave a comment and subscribe. Lastly, please leave a rating and comment to the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.